very agile in order to help them to deliver the service level required to our customers. So we embraced the Lean Six Sigma operating model, which really very effective in terms of moving the people to focus on the change, continuous change and improvement in their environment. And we have trained almost all the staff on the system itself, and there are a lot of people who have gone higher to green belt and black belt, which really, very advanced in terms of the financial sector. This is more operated in the industrial sector, but the financial sector was new for this kind of concept, but it really helped people making the change. Of course, the performance culture is very critical. You want, and at the end of the day, we are a profit-making organization, so we need to also, share our shareholders and stakeholders looking for return for that. So we built the performance culture within the staff themselves in order to sell and cross-sell and understand the customer requirement and tailor for them the services that are required so that they are retained and continue their services with the bank. The brand is very critical. I mean, Bank Dhofar brand is strong, but at the old days, it used to be, bank that is a strong bank, stable bank, but not fresh and not agile. It was not looked at that. With the change, so we simplified the logo of the bank. We simplified the name of the bank. We shortened it. It used to be Bank Dhofar Al Omani Al Faransi. So we said Bank Dhofar is the word where people will remember more. So we continued in that journey. So we built the brand. The brand is now very prominent. It's available. You can see it all the place, and it has the confidence of the stable bank and that. So this is actually the story of Bank Dhofar from the start in 1990 until now. Moving forward, we will build on these pillars that we have established for the strategy because we think they are sustainable for the future, and we will build on them to continue growing the organization organically and non-organic as well if the opportunities come. I would like to invite our CFO, Mr. Vikesh, to cover the part of the numbers now, to share it with me. We're trying to make a little bit change than the normal change in the morning, one person doing it, so we thought we'll share the floor together. Thank you very much. I will be available. I will be available here for taking questions as well.
Thank you very much.
You're welcome.
Oops, this is a little tilted. Good afternoon, everyone, and thank you, Mr. Abdul Hakim, for taking us through the Bank Dhofar journey over the last 32 years. Mr. Ahmad, you mentioned Bank Dhofar is 15 years young. So I must say I'm actually twice as young as you are. So just to start on the lighter note, post-lunch session is always a little tough. So if you do feel sleepy, it's not me, it's the food that you have just eaten. So you'll have to excuse me. So just starting with my presentation. Okay, a customary disclaimer slide. Of course, any forward-looking statement that we do has to be seen with caution in terms of course, this is largely the management assumptions of how our performance is. Looking at a broad level snapshot of the bank, we are the second largest institution in terms of asset in Oman, with a total asset size of close to 4.38 billion Omani Riyal. My presentation, by the way, is in OMR, so any international investors present here or any one of you who have joined online can see the US dollar presentation on my website, but the one that I'm presenting right now is in Omani Riyal. So yes, we are the second largest institution in Oman with 4.38 billion in terms of assets and close to 1,493 employees as at the end of second quarter of 2022. Our market share in Oman stands at 13% in terms of assets, 13% in terms of loans, and 12% in terms of deposits. We do have a diversified offering various products to our retail, corporate, as well as treasury and Islamic banking customers. We do enjoy a strong capital position with a capital adequacy ratio of 17.15% and the CET1 ratio of 12.59% as at the end of second quarter 22. Our credit, we are rated both by Moody's as well as Fitch. Moody's rating being Ba3 as well as Fitch rating at BB minus with a stable outlook. We are supported, as was briefly mentioned, we are what we are because of our people. So we are supported by an experienced management team, which take active part in running the business. The table on the right side shows the financial highlights of the bank. The total assets have increased from 4.2 billion to 4.376 billion as at the end of second quarter 22. Total equity stood at 701 million at the same time. Net loans and advances stood at 3.321 billion as at the end of the second quarter. Customer deposit at 2.953 billion. Operating income, as you can see, was largely flattish starting 2018 and as we came out of the pandemic years, and stood at 70 million in the first half of 2022. Net profits, which took a dip because of, again, pandemic-related issues in the year 2021, has started improving and stood at 16.4 million as at the end of second quarter 22. I talked about the CET1 ratios and capital adequacy ratios, which are higher than what regulatory requirement stipulates, capital adequacy ratio being 17.15%. Our ownership structure, this slide shows the various shareholders that own the bank. The bank is predominantly owned by, to the extent of 25% by various government-related entities, giving a very strong, sticky government-related relationships to the bank. The graphs on the bottom of the slide shows the total segmental split of our various businesses, as well as the net operating income that we derive from those businesses. As you can see, corporate banking on the left-hand side occupies 44% of my total balance sheet, retail banking at 26%, treasury and financial institutions group at 14%, and MIBS, which is the Maisra, the Islamic banking arm of the bank, at 16%. Our net operating income is similarly split well in terms of the overall diversification that it gives to my net operating income line, with corporate banking accounting for 47%, retail banking at 32%, treasury at 6%, and Maisra, which is the Islamic banking arm, at 15%. Moving on. This is a bit of a struggle. Should I be pointing it to? Can you move the slides for me? This is not working, it seems. So we did run into some technology issues. It's not working. Maybe if you can move the slides for me. Maybe I'll keep talking till the time the slides come over. Some of the key credit strengths that Bank Dhofar enjoys, of course, as I said, is being a leading franchise in Oman with the second largest position in terms of assets in the banking industry. We do have a diversified product offering, as I talked about, offering various products to retail, corporate, treasury, as well as Islamic banking customers. Our government ownership to the extent of 25%, giving us a very strong, sticky relationship with various government-related entities. We predominantly operate out of Oman, which is, again, providing a very strong and growing operating environment in the current turmoil that we are seeing in the global economy. We do enjoy a solid, robust capitalization, as well as a very diversified and smart distribution network. We operate out of 64 branches spread across Oman, as well as close to almost 201 ATMs, CCDMs, as well as fully functional machines. Moving on, in terms of business segments that we operate with, maybe just go back since you have come. Just go back to the previous slide, please. Slide number 14, I would imagine. Yes. The business segments that we operate in essentially includes retail, which is the extreme left that you see. Wholesale bank, that includes both corporate bank as well as treasury and financial institutions group. And Maisra, which is the Islamic banking arm of the bank. Retail banking provides banking services to close to almost 290,000 customers. As I said, out of 64 branches with 122 ATMs, 57 cash deposit machines, and 22 fully functional machines. Corporate banking services almost 22,000 customers as at the end of the second quarter of 2022. Again, the customer base is well spread across the industry segments. Treasury and FIG offers various products, which is the financial institutions group, offer various products to our customers, both across retail as well as the corporate banking division, which includes foreign exchange, derivatives, money market products, etc. And Islamic Bank, which was only launched recently in 2013, which is again a leading Islamic banking franchise within the country, offers products to its customers, which includes treasury, investments, retail, as well as corporate banking businesses. Next slide. Next slide touches upon the profit and loss statement for the first 6 months of 2022 as compared to 2021 H1. On the extreme left, you can see the net interest income and the financing income increased by almost 18%, which was an increase of almost 9 million as compared to last year, from 49.9 million to 59 million. Now, this mainly came about because of improved net interest margins. The net interest margins last year stood at 2.01%, which has now increased to almost 2.45%, an increase of 44 basis points that the bank could achieve in the last 6 months. Operating income, which is the total income, went up from 63 million to 70 million, which again is an increase of 7 million, an increase of almost 11.23%. Costs have largely stayed flattish, and with a marginal increase of almost 700,000 Riyal, from 33.6 to 34.4 million as at the end of second quarter. What is important, as I briefly heard, was the operating income, which is the net of operating cost, which went up from almost 29.4 million to 35.7 million, which is a significant increase of 21.43% as compared to last year, which is an increase of almost 6.3 million. The bank continues to set aside a significant part of the profits as provisions, which, as you can see, has increased from 9.7 million to 16.3 million, an increase of almost 68%. Now, this is a conscious strategy that the bank has adopted to make sure that the provision coverage ratios improve over a period of time, which is now currently at almost 97.4%. Net profit, because of the higher provisions, went down marginally from 17 million to 16.4 million as at the end of second half of 2022. Next slide talks about gross loans and advances. As the bank comes out of the pandemic year, it continues to be conservative in terms of its lending approach. The gross loans as at the end of first half of 2021 stood at 3,489 billion as compared to June 22, where it was 3.511 billion. The evolution of gross loans is shown on the chart on the top right, and again spread across various industry sectors. The various sectors that we lend to, again, is very well diversified, which includes retail, international construction, manufacturing, services, etc. And the product mix is shown on the right, bottom right, which again includes loans, loans against trust receipts, Islamic financing, as well as overdrafts. Next slide talks about the non-performing loans as well as the asset quality. The non-performing loans as at the end of 2019, in terms of percentage, stood at 4.67%, which has increased to almost 90 basis points to 5.57% as at the end of second quarter 2022. Having said, the bank, as I said, continues to set aside significant provisions to improve the coverage ratios, which has gone up from 79% to almost 97.4% as at the end of the second half or first half of 2022. Now, the coverage ratios obviously includes the provisions, the ECLs associated with stage 1, 2, and 3 as compared to the stage 3 non-performing loans. Next slide shows the funding and liquidity. The bank's balance sheet is well funded through various sources, which includes customer deposits, largely CASA, and other term deposits. Includes other liabilities, subordinate loans, close to almost 35 million riyal. Tier 1 capital securities, which is basically the perpetual that the bank has raised, which is close to almost 155.5 million riyals, and that is how the balance sheet is funded. In terms of the customer deposits, it stood at 2.953 billion as of the first half of 2022, as compared to almost 3 billion previous year, with CASA constituting almost 43% as compared to 47% last year. Profitability and performance. The chart on the top left shows the net revenue breakdown over the last 4.5 years. As you can see, the total operating income, which was largely flattish over the last 4 years, from 132 million to 130 and 126 million, stands at 70 million in the first half of 2022. So it has started showing improvements at the backdrop because of improved net interest margins. The non-funded income, which was 13.13 million last year in the first half, stands at 11 million, which is a decline of 2 million, but that's mainly because of some of the one-offs that we had taken in the previous year, which is 2021. Otherwise, the core fee has marginally improved as compared to the last year. Because of the higher provision that the bank had taken in 2021, the return on equity came down to 4.61%, which has now improved to 6.1% in the first 6 months of 2022. Operating expenses, as Mr. Abdul Hakim briefly mentioned, the bank invested significantly in various transformation initiatives starting 2016. So the bank continues to invest in technology as well as its people. That had resulted in a cost-to-income ratio upwards of 50%, which mostly peaked at 57% last year. In 2022, first half, first 6 months, the cost-to-income ratio has declined, mainly on account of flat cost as well as improved operating total income, and now stands at 49.1%. The graph at the bottom of the slide shows the operating expenses breakdown, which was 65 million total cost as at the end of 2020, increased to 72 million in 2021, and stands at 34 million in the first 6 months of 2022. So again, the cost-to-income ratio, which was upwards of 50%, has now started declining and currently stands at 49.1% and is in the right trajectory, right path. Looking at the yields, the cost of funds, and the net interest margins, the asset yield, which was again at 5.33% in 2019, dipped to 5.14% as at the end of 2021, and has since improved by 14 basis points to 5.28% in the first 6 months. One of the significant achievements that the bank could achieve was the reduction in cost of funds. The cost of funds, which was always at upwards of 3% and stood at almost 3.13%, has now declined to 2.83%, which is a reduction of almost 30 basis points. This is again on account of various ALCO initiatives that the bank has undertaken, plus largely focusing on non-price sensitive sticky deposits that has led to a reduction in the cost of funds. Because of the reduction in cost of funds, at the same time improving the asset yield, the net interest margins went up from 2.01% to 2.45%, again an increase of almost 44 basis points, giving a kicker on the total income as of the first 6 months of 2022. Next slide talks a bit more detail on the capitalization, the capital adequacy ratio for the bank. As I initially mentioned, 17.2%, 15% is the total capital adequacy ratio as compared to the regulatory requirement of 12.25%. Our CET1 ratio stood at 12.6% against a regulatory requirement of 8.25%. So the bank continues to be robustly capitalized and ready for growth opportunities. The bank has consistently paid dividends over the last couple of years. In terms of total cash payout, it stood at 8.99 million as at the end of 2019, which dipped to 5.9 million as at the end of 2021 as the bank set aside provisions in 2021. And in terms of rate, it was 2%. The risk-weighted assets have largely stayed flattish as the bank came out of pandemic and followed very conservative approach towards lending. So to conclude, some of the key thoughts that I would leave you with: operating profit, as I talked about, which is basically total income net of operating cost, has seen a significant increase, stood at almost 35.7 million, which is an increase of almost 21.4% in the first 6 months of 2022. Cost to income ratio, which was always upwards of 50%, has now declined to 49.1%, mainly on account of flattish cost as well as improved top line. The bank continues to focus on increasing its footprint, which is basically the branch network as well as the ATM and CDM network. This is a conscious strategy to reach out to our customers, and as Mr. Abdul Hakim briefly mentioned, one of the core pillars of our strategy is to offer the best to our customers in terms of both reach as well as products. So this is something that the bank will continue to focus on. Focus on improving asset quality and prudent provision management. You must have seen that coming through the profit and loss statement of the bank, as the bank continues to set aside significant provisions to improve the coverage ratio. The ECL went up almost 68%. This is part of, again, that strategy to de-risk the balance sheet. And experienced management team, we are only as good as our people, and the bank continues to focus on looking at upskilling its people as well as having an experienced management team to drive the bank's performance going forward. I think this is largely what I wanted to share with the audience today, and open for any questions, both myself as well as Mr. Abdul Hakim. I'm happy to take on any questions that you may have. That's post-lunch syndrome, I see, it seems.
No. No question. Shukran.
I think.
Eh?
So presumably there's none. So thank you very much, and apologies for the slight technology challenges. Thank you. Thank you.
Thank you, Mr. Abdul Hakim Al-Ujaili, CEO of Bank Dhafar, and thank you, Mr. Vikash Mirani, CFO of Bank Dhafar. Last but not least, we will be hearing from Mr. Abdullah Zahran Al-Hanai, CEO of National Bank of Oman, a strategic sponsor of this event. Please give him a warm welcome to the stage.
Bismillah. Assalamu alaikum wa rahmatullahi wa barakatuh. I see I'm missing a lot of people and empty tables, but first of all, Haytham, thank you very much for organizing this event and inviting us, especially NBO, and thank you to your team on a well-organized, despite the electricity shutdown. So thank you very much, Haytham. I think with every challenge, there's an opportunity. So I'll benefit from this opportunity and cut short my presentation because of the electricity problem. So I'll try to be quite fast and move fast on our presentation. Given also the series of presentation that happened this morning, which was very well articulated and eloquent in terms of what is happening on the macro side, what are the different government initiatives, and then a well-presented slides on the banking sector. I'll try not to repeat myself, but to tell you the story of NBO. NBO is operating predominantly in the Omani market, but might have a slightly different story from the rest of our peers in the banking sector, where we are working on transforming the bank and trying to catch up with the rest of the industry players. They offer us an amazing benchmark and an amazing leadership in their own organizations, and we are trying to copy and emulate those kind of approaches. I hope this is working. Yeah. So very quickly, I'll focus on the extreme right-hand side for yourselves in terms of the key messages that we have. NBO is the oldest local bank, and we are very proud of this fact. It was founded in 1973, and next year, inshallah, we'll be celebrating our 50th anniversary in February of next year, inshallah. And we hope to see you in our celebrations then. So it has a very long-term relationship with different participants of the economy, be it government, private sector, individuals, but maybe we've lost our way in the past few years, and our hope and aim of our strategy, which we'll be presenting next, is to bring back and rebuild those bridges back, and bringing the customer as a focus for whatever we want to do. There's been a complete change in terms of the management. A new management was introduced late 2020, and subsequent months we've introduced many new team members. We believe now we have a very strong team that will execute and deliver the objectives of the strategy. That brings me now to the 5-year strategic plan. We presented this plan to the board in late 2020. It was approved sometime in November of 2020, and we've immediately embarked on execution. And we, alhamdulillah, completed over 1.5 years of the execution. And I'm happy to share that it has been quite successfully executed till date. And we are building capacity to continue with the growth and to continue with the execution of our transformation strategy. And the numbers are very clear. Well, we've demonstrated whatever we promised, we've either delivered or exceeded whatever we promised. The other elements, I think a lot of my colleagues have talked about, it's strategies that we've adopted, but also the macroeconomic picture and the sector has helped us in terms of the liquidity situation that is there. But I would like to highlight that NBO maintains a very strong franchise on the liability side, a very strong CASA generating machine. We are, our CASA ratio to total deposit is around 66%, which is one of the highest in the sector. Technology, the DNA of NBO has been extensive investment in technology. We continue on that trajectory, and a lot is planned as part of our 5-year strategic plan. Finally, and last but not least, the shareholding base, a very strong shareholding base, which are predominantly institution, but also large family group. We have the Commercial Bank of Qatar, which owns slightly less than 35%. The Suhail Bahwan, or Sheikh Suhail Bahwan directly now, owns about 14.5–15%, and government and quasi-government and pension fund own about 27%. So a very strong shareholder base, and that has been demonstrated when we came to refinance our 81 issuance, which came for maturity or 5-year lapsed last in 2020. and we were able to place $300 million to our shareholders through private placement without tapping global markets when those markets were closed, and we were able to do it successfully and maintain our credibility with international investor rather than postponing the call and affecting our investor base. This is the slide that I would want to spend my time. Again, like I mentioned, I'm taking this as an opportunity to reintroduce NBO, explain what we've been doing the last 18 months, and what we hope to achieve up to 2025. There's nothing magical, but it's part of the dynamism of the team, the execution of the strategy, and commitment from each member of the management team is that we'll never take shortcuts. We had multiple opportunities in the past 18 months to try and manage the situation, but we've always opted out to either transparency, sticking to whatever we've committed. Third, took the most difficult road to ensure sustainability of whatever numbers we show and demonstrate and perform. So if you allow me, I'll take a few minutes on this slide and just remember the context of this presentation or this strategy was at the peak of the COVID situation, late 2020, sometime in August, September of 2020. We had three key strategic priorities. The first is safeguarding the balance sheet. Two, post-safeguarding, building value. Third, sustaining this value for a long term. And people who are familiar with NBO, we always had our ups and downs over the past many years. So it was very important from the management team to commit to the board and to shareholders the sustainability of this performance. And key pillar of these elements were transparency, ensuring that whatever we commit, we deliver. When we talk about safeguarding, there are three pillars to it. One is the liquidity pillar, second is the capital pillar, and the third is the asset quality pillar. On the liquidity pillar, again, the context when cost of funds was going up, there were uncertainty given the COVID situation, and post that as well. We wanted to make sure that the franchise that had generated us strong CASA to continue, even during the most difficult time, and to continue to build that and try to bring cost of funds down. The other element was the bank had got addicted to a lot of other instruments in terms of bridging the gap of its asset and liability. We've changed that, and we've approached it more naturally in terms of generating liquidity for the bank. On the capital piece, like I mentioned, a key issue for us was dissatisfactions from international investors when we did not call the 81 after completion of 5 years. Although it's an agreement between us, it's perpetual, but there's an understanding between an issuer and investors that you tend to call after a certain period of time. We were not able to do it. We used the COVID situation, which was a reality. But then at the first opportunity, we went back to our shareholders and asked for support, and they demonstrated the support. The major shareholders came in and invested $300 million to refinance the existing $300 million that was supposed to be repaid. And again, going forward, our strategy is to ensure a strong internal generation of equity, but also a balanced distribution strategy to shareholders. The third element is the asset quality. We were hit, and maybe we were the worst performing bank in 2020, given the huge amount of provisions that we had. We had 3 operations, Oman, UAE, and a little bit of Egypt. And in each of these localities, we had asset quality issues. So we had to arrest that situation. Alhamdulillah, a lot of progress has been brought in to convert that to opportunities as well. And we are going now through line by line to ensure that appropriate discussions, settlement, etc., whatever is possible to ensure recoverability of those non-performing assets. But more importantly, not to learn from mistakes and not to repeat it again. So a lot of work is being done in terms of our risk appetite statements, early warning signals, and other aspects to ensure that we don't get into similar problems in the future, inshallah. On the value creation, revenue, optimization, and partnership are 3 pillars of our strategy. On the revenue piece, it's important to generate strong revenue lines. And again, we are happy to see that our share of non-funded income or fee income is about 30%, while net interest income is around 70%. Our hope is to enhance the non-fund or the fee income side to even higher level through new business lines and focus on other income-generating opportunities. The optimization piece, NBO run the bank at excess of 55% cost to income. I think a lot of my colleagues have referred to these ratios in the past couple of presentations, and that was not sustainable. We were spending, but not generating enough revenues with that spent. So again, it's not cost-cutting, but optimizing. So we are spending. We are still investing. We are investing in people. We are investing in infrastructure. We are investing in technology, but putting every rial or every dollar in the right place. As a result, we have the best jaws, which is higher operating or other income and lower operating expense, giving a very positive jaws, which is something that a lot of investors look for. And we will continue with that. On the partnership, that's another element that we are keen, and it's part of NBO's DNA, and we are looking at leveraging that. We don't shy away from partnering with whomever. We are happy to partner with our peers in the industry, with entities outside of this of the banking industry, and we believe that's a win-win situation, and it's something that is part of our strategy as a value creation rather than a competitive force for us. With all that effort, we need to sustain performance and brand, but I'm not talking about just the marketing aspect. It's simply answering the question, why should a customer deal with NBO? We did not reach to answer. We are attempting to reach to an answer. It encompasses a marketing, a PR, customer experience, ensuring whatever we promise the customer is delivered again. And they are always at the center of whatever we do. The digital piece, like I mentioned, digital is part of NBO's DNA, and it will continue to be part of our strategy going forward. Finally, but again, not last and very important, is our people. We have about 1,500 employees. It's important to upgrade the skills. We've already embarked on a program on reskilling. A lot of skills that are there might not necessarily be the skills of the future, especially with digitization. A lot of work can be automated and the risk of people being redundant, but we are working on retooling and